Well, it's the trading day right after the Easter celebrations. Are you ready to hit the markets at this point? Welcome to Business Morning. Let's get straight into it. We know the markets are already buzzing globally at this point, and also right here in Lagos, Nigeria. Let's get you the top stories now. Nigeria's business environment showed signs of weakening momentum in March as the latest business confidence monitor released by the Nigerian Economic Summit Group, that's the NESG, revealed a drop in the confidence index to 101.2, down from 117.2 recorded in February. The decline reflects growing concerns among businesses over persistent economic challenges, including rising costs, currency volatility, and weakening consumer demand. While the index remains above the 100-point threshold, indicating overall expansion, the sharp month-on-month drop signals a slowdown in business optimism across key sectors. According to the NESG report, firms experienced increased operational pressures in March, driven largely by higher input costs and difficulties in accessing foreign exchange. Many businesses also cited logistics constraints and an inconsistent power supply as factors affecting productivity and profitability. I guess it's a no-brainer. We all expected some strain in the month of March, and we're already seeing that from the data there. Then, moving on now, two of Nigeria's leading businessmen, Mr. Femi Otedola and Aliko Dangote, they met with President Bola Ahmed Tinubu to discuss the state of the economy and ongoing reforms. The meeting, held in Abuja, focused on strengthening collaboration between the private sector and government, with discussions centered on economic growth, investment, and policies aimed at improving the business environment. The engagement comes as the federal government pushes ahead with key reforms, including efforts to stabilize the power sector and attract investment, with both business leaders reaffirming their support for policies that drive long-term economic development. And back to the star of the markets now. Oil prices have extended gains in Asian trading as investors they brace for a potential escalation in the Middle East ahead of U.S. President Donald Trump's deadline for Iran to reopen the Strait of Hormuz. And we see the change there, big jump as expected. And we see the gap between WTI and Brent crude that has widened. Normally, Brent should be more expensive than WTI, but we're seeing that spread growing bigger, with WTI leading at this point, $114.92 a barrel, up a bigger 2.23%. Brent crude there holding on $111.43 a barrel, 1.41% higher. We'll drill down later on the show on why this continues. That's WTI outpacing Brent in price. And back here we see crude oil supply from Nigerian producers to the Dangote Refinery saw a significant increase in March, rising to 10 cargoes compared to previous months, signaling improved domestic feedstock availability for the facility. The development marks a notable step forward in efforts to boost local refining capacity and reduce reliance on imported petroleum products. The increase in supply comes amid ongoing adjustments in Nigeria's crude allocation framework aimed at prioritizing domestic refiners. I was here as the Group Chief Executive Officer of the NNPCL, Mr. Bayo Julari, clocks 1 year in office. The Petroleum Products Retail Outlet Owners Association of Nigeria, they're asking for the resumption of operations at government-owned refineries. According to the national president, Dr. Billy Gillis-Harry, this will give room to the governments to maximize the increased revenue from crude due to the Middle East crisis as a buffer to consumers of petroleum products in the face of surging prices. Take a listen.
We have somehow met with some of those companies that are interested in taking over those refineries, especially the ones in Port Harcourt, because the one in Port Harcourt was already producing, but for some reason about commercial viability, it was put on hold. So we will really think that the best way to go would be to collaborate with the grassroots stakeholder environment in the industry, and also companies that have the capacity to bring in funds and technology and make the refineries to work. When you sell it, whoever that buys it will actually make a business out of it. And Very frontal in our mind is the element petrochemical that is in a lesser element there. That facility was lying fallow, doing almost nothing commercially until an Indian company procured it. And look at the size of business that that company is doing and the kind of input that the economy, its activity is pumping into the economy of India and some minimal value to Nigeria. So we don't need to make those mistakes anymore. We need to focus on exactly what will be beneficial to Nigerians, not short term, mid-term and long term.
All right, now to our first conversation. As Nigeria's financial market evolves, we're beginning to see something new and potentially transformative taking shape. The rise of structured finance products, not just as one-off issuances, but as repeat multi-series instruments, from recent listings on FMDQ Securities Exchange Limited to the successful rollout of sovereign bond-backed notes through special purpose vehicles. The question is no longer whether these instruments can work, but whether they can scale. Well, that shift raises some important questions. Joining me now to help us unpack this, we have Dr. Sunny Babatunde Ayeri, is the Group CEO, DLM Capital Group, joining me right here in the studio. It's great to have you, sir.
Good morning.
Happy Easter.
Thank you.
In arrears. Happy New Year. It's
Absolutely.
been a while. Great to have you again.
You too.
And last time we were here,
we
did talk about structured finance.
Of course.
You had an issuance.
Yes.
Back then. How did that go?
Well, it was pretty successful. And it's one of the things we want to talk about today. Remember, that was sometime about September last year.
Yeah, about September.
That was when it was issued. And the first coupon, which includes the principal, has just been successfully paid, with ease, I might add, and excess to spare. So the investor appetite, the reality back then was that we've never seen this before. How can a AAA rated instrument be giving me 40+% return hold to maturity? So a few people were like, this is different. I don't understand
this.
Seems
too good to be true.
Exactly, things like that. But, again, like everything else, it's always the proof is what? In the pudding. So being able to demonstrate, right, to investors that exactly what you see in the prospectus is exactly what's happening, has given investors a lot more, okay, hey, maybe I read this wrong. Maybe I should be looking at this again.
Right.
And we've had a few calls like, you know what, when you come for the next time, when you come for a series 2, please make sure, we're there. So,
right.
Yeah, we're looking forward to it.
Because, it's quite interesting. I remember that time we talked about it. It was a mixture of government debt.
Correct.
And some risk.
Some real sector cash flows.
Real sector cash flows.
Correct.
So, let's go back.
Let's go back. Yeah. So, sovereign bond composite notes. Basically, the word composite obviously means to put two things together, right? Compose. And the whole idea was to combine cash flows coming from coupons of federal government bonds or sovereign bonds, all right, and cash flows coming from the real sector to give that beautiful enhanced yield to investors. Now, one of the beauties of this transaction is that whether or not, and I'm going to repeat this again for the audience, whether or not real sector cash flows come through, investors will still get their full principal and interest back. 100%, a mathematical certainty. Mathematical certainty. You will still get your principal and interest back, whether or not real sector cash flows come through. Now, what does that mean? It means for the first time, there is a product now that pension funds, asset managers can invest in that allows them to take real sector risk or any other sector risk, right?
Because some of us love risk.
Yes.
Because sometimes when it's not risky, it doesn't pay that well. When it's risky,
it pays well. But now this is where it is basically counterintuitive, because you now have an instrument that actually pays well, but
safe.
Correct. You see? So one of the reasons why it has the AAA rating is because it does not, right, have, in terms of when the rating process actually excludes monies coming from the real sector. It only takes into account cash flows that are coming from sovereign. And that cash flow is sufficient to cover.
So technically, we're moving from, you know, the plain vanilla debts. That's, you know, FGN bonds and T-bills. You know, the one most investors are used to, most especially retail.
Correct.
You know, at this time. So definitely you've spoken to investor appetite. I guess it was quite strong. And most of it is institutional investors.
Correct.
What's happening with retail?
Well, I mean, it's not that retail can do this also, right? Something that I would need to look at with the Securities and Exchange Commission, because obviously for something of this nature, you'd want the SEC to actually, I mean, it's obviously this transaction as is, it's SEC approved, but it's SEC approved for qualified institutional investors, not for retail investors at this point in time.
I'm sure retail investors will be watching on the sideline and saying,
yes, we all might, you know, exactly. But to say something, and this is kind of like a conversational detour here, is that we're also working on something that will be fantastic for retail investors, especially now at the beginning of the equities boom, where we're now creating a product that would allow retail investors be able to take risk within the equities market, but for the first time have the certainty that the money invested will be returned. Yes. So unlike in those days, I mean, let's take the last crash, right? Which was 2008, 9.
And some of us, many people have not recovered.
Exactly. So, but the thing is, you know, then people went to the market completely naked. Yeah? So you took the risk 100%, right? If it goes well, it goes well. And if it doesn't, I mean, there was, I think, circa 70% drop in the index back then. So a lot of people lost their shirts. What we now, from that experience, we're working on something now that would ensure that that never happens to the retail or even institutional investor going forward. So there's something in the pipeline that's dedicated for retail guys.
Yeah, because I guess, you know, the average investor out there that's retail, they've been through a lot.
Oh, yes.
You know,
we know
coming
that.
in from
we know that.
2025 into 2026, the first quarter, the war in Iran, we're paying so much.
I know.
You just buy fuel, and some of us say, I don't have money to invest, you know, at this point, but at the same time, I want to invest.
Yes.
I want to make money, I want to make wealth.
Absolutely. So there, you know, another area that needs to be considered and worked on is also tokenization. Real world asset tokenization, which again, the SEC, the Securities and Exchange, you really have to commend the Securities and Exchange Commission for what they're doing, helping to really enhance and develop and widen the scope of products available. But you see, the cool thing about tokenization would be that for the first time, you're able to also now buy you know, take for instance the refinery, tokenizing that would allow the average person, I mean, when I say average person, let's put it bluntly, the mekunu on the street will be able to put his, whether it's 500, whether it's 1,000 naira, you get my point, right? Token. So that whatever value it brings in future, that investor can also participate in that you know, value creation or wealth creation, all right? So in other words, that will be bringing it right down to the bottom, you know, of the pyramid, so to speak, and really totally, you know, open the floodgates to a real diversified shareholder base, you know, using that sort of technology.
Yeah, definitely. Interesting to see how far tokenization actually goes, you know, especially in a country like, you know, Nigeria. We're definitely rooting for that.
We're going to do it
going forward. So we have the listing on the FMDQ exchange.
Yes.
What does that mean for investors in practical terms?
So you know, when we were marketing back in September, I remember telling investors then that this bond will be the most valuable corporate bond on the street. And of course, a lot of people thought, Yimu, so to speak,
Right.
exactly, which means, yeah. All right, but it was so gratifying to see that when it was actually listed, it did become the most valuable, and I expect it to become the most valuable. In fact, continuously, because as the bond pays down, right, the yield continues to go higher and higher and higher, and therefore the value is expected also to go higher. So, it really was gratifying to see that happen. And for me as a person, looking at it from conception, which is sitting down somewhere and thinking, how can I create this? Right up to the point where, it's finally, it's like, think about it. You conceptualize, you go through the rating agencies, you go through the financial modeling, you go through the legalese, you go through the SEC approval process, then you have to go market it. Do you know what I mean? And then after marketing, you then have to get it listed. And after that, we still do, by the way, quarterly performance reports. So that again brings transparency to the product. So what this means is every quarter, investors are brought up to speed as to how much has been collected, all right, where's it sitting, so on and so forth. So you know exactly how your underlying transaction is performing. That's one of the beauties of structured finance, by the way, different from plain vanilla. Plain vanilla, you have what is called event risk. Okay, a company is there today, it might not be there tomorrow. All right, just being to exaggerate and to explain my point. But with structured deals, right, which are predominantly based on cash flows, right, you can actually see the cash flows coming through. All right, and when you see a deterioration in them, right, you already have an idea of how the deal may not be doing as well as I thought it would do. Some people might actually get out by then. You know what I mean? And if you see it doing exactly how it's expected or doing better, so on, same story. But the most important thing is that is one of the big differences between structured deals and plain vanilla deals. Right? Is that with structured deals, they're based on cash flows. You can consistently see those cash flows coming through, normally through your performance reports. Sometimes they're monthly, sometimes they're quarterly. But the whole idea is to make sure that the investor is given as much, well, I wouldn't even say as much, total transparency on the underlying collateral and the cash flows being collected.
So with your experience so far, in this process, where would you identify as the risk points? And, for where we are right now, starting this new type of investment for this market, do you see it growing in Nigeria, that's structured finance?
Oh, yeah.
And help us point out those risks that you think investors should be educated about.
Okay, so let me go back a second. I mean, the first structured deal, actually, in Africa, I was involved in that. 2001. Tokwini, it was called. It was South Africa. It was a company called SA Home Loans, and they were doing mortgage securitization. In fact, it was the first transaction I worked on when I joined IFC in Washington. Right? That was 2001, which is what now, 25, 26 years ago.
Wow, that's a long time.
Yeah, so. All right, so that was the beginning of structured deals. Again, I'm excluding MENA. MENA means Middle East, North Africa. Right, so I'm talking about, but I think it's derogatory, but Africa, down now. That word I don't like it. Anyway, so that whole part of Africa, that's the first deal. The second deal, I was also involved in that. That was when we did FMBN, Federal Mortgage Bank, 2006, 26 billion back then, under 100 billion mortgage securitization program. That was when Obasanjo was president, and monetization. I don't remember when civil servants were given the right to buy their homes back then, right? So the loans to buy those homes were then securitized, all right, under a guarantee provided by the federal government. Our dear senior sister, Ngozi Okonjo-Iweala, was finance minister at the time. Right. And I worked with, of course, then I was at UBA Global Markets, which is now United Capital, UCAP. And that deal was successfully consummated. Yeah, that was then. Then we had, I think, if memory serves me right, we had another transaction, SEPAC. right? SEPAC was it's like Nigeria's green card, right? Where foreign people that work in Nigeria have to pay a specific annual amount. The acronym escapes me right now because they had something like alien something something. But anyway, it's called SEPAC. And again, that transaction was another fantastic. That was the first future flow. So the transaction we talked about, the first one in South Africa was a mortgage-backed securitization. The first one in Nigeria was mortgage-backed securitization. The third one was a future flow transaction, which is basically securitizing cash flows that are expected to come in the future. Again, when that was being marketed in 2017, if memory serves me right, skepticism everywhere, especially from the funds, all right? But, by the time we were paying off that bond, it was so gratifying to see that 90% of the holders were all pension funds. Yes. Because it had performed so brilliantly well, as predicted. That's one thing people need to understand about these deals. Structured deals are like mathematical precisions. It's not like, credit is credit. And I understand credit, but this is mathematical computations where, and that's why numbers are brilliant. 1 + 1 is 2. You can't, there's no way about it. Exactly. So the reality basically is it's all about computing these flows, and you're looking at what is the probability that these cash flows will continue. And going back to the age-old saying, we have to look at where we're coming from to know where we're going. So it's almost like saying, if these cash flows have been doing this well for this period of time under all these sort of stress scenarios, then the probability that they continue, all right, is pretty high. And that is why it's possible to then assign ratings of AAA, AA, and so on and so forth, based on cash flow predictability. All right? So now we're moving into, sovereign, what we've done here with the sovereign composites is actually, another thing special about it was first transaction structure that allowed a company to raise money at the AAA level when it's a BBB minus. That was a 9-notch upgrade.
Wow.
Without securitizing, by the way. You see?
That's a huge deal.
Oh, yeah. And that's why, yes, according to ChatGPT, Claude, first ever. Never done before. So those are the beauties about this. And, it's like when you're able to put your mind to something and say, we will make this happen with that sort of conviction. I always believe that nothing is impossible, so long as it really is down to how bad you want it to happen. And can it scale? Absolutely can scale. Why do I think it will scale? It's because as investors begin to understand the fact that this product is allowing me to invest in different sectors, but giving me, for lack of a better word,
right.
Yeah, capital preservation at the minimum. So if I let go of 10 billion or 20 or 30, right, I know that come what may, my 30 will come back.
Fantastic. But I'm going to hold you. I'm going to hold that thought for a moment now. Yeah. Let's join the live coverage now for National Police Day 2026. That's for our DSTV subscribers, but you can still follow the money right here on Business Morning. Definitely been an interesting one.
Thank you.
And I know that we're going to see other series,
of course,
coming at this time, and investors are trying to beat a lot of things now. Yeah. We're trying to beat inflation. We're trying to beat that's for retail.
No, even institutionals want to beat inflation.
They're trying to beat inflation.
Of course, yeah.
High interest rate environment and all of that, doing business.
Yep.
What are you seeing going forward? For the economy.
For the economy?
Yeah.
Look, I see the economy doing very well. Okay. The policies that have been put in place, that are being implemented, and I know Nigerians, we're all going through a very painful time right now. It's very painful, but let me use the Bible adage, it shall pass. It shall pass. People, it shall pass. Like everything else, a house is not built in a day. It takes time. And during that period, you go through a lot of pain. And that's what's going on right now. It's like really restructuring a lot of the flaws of the past, all right, to achieve some form of sustainable long-term growth. I think what Nigeria basically needs is that, even from a political standpoint, it's just a level of certainty and continuity going forward, so that policies continue to really build on top of each other, rather than build, dismantle, then build, dismantle, build, dismantle. We need to come to a point where, so that way, once that pain has passed, it's passed and it's passed for good. But my own view is that a lot has been done. Private sector, people like Dangote, have done, amazingly well in terms of helping the economy with the refinery. We've got to say that. Cement, national production rather than import, used to be. So a lot of these things, they take time to manifest, but the reality is, and then also in terms of cost of things, the reality is that, like in economics, is that the wages have to rise. It can be sticky, as they're using the term that we use in economics. It can be sticky, but right. The reality is that wages will eventually rise and exceed. Let me give an example. Let's go back to 2007, when the Naira was about 100 and something, yeah? And it was a real feel-good time, yeah? I want you to think about people who lived when it was 1980, when Naira was 5 Naira. Do you think they would have ever conceived that people would say 100 Naira, 100 and whatever is fantastic and it's a good time? Thank you. The same way, in 10 years' time, 1,000 would look like, wow. Hopefully, we will never go beyond that.
Hopefully.
Thank you.
Yes.
But the point basically is that we need to get to the point where wages, etc., exceed that, and we're also able to achieve and maintain stable macroeconomic indicators, which I have to give, again, kudos to the central banking team led by Cardoso, Philip Ikerzo, and so on. Great job that they're doing there too.
And we definitely pray, we continue to see stability and maybe some strengthening, at some point.
It will happen. It will happen. Look, the reality is, if not for the Iran conflict and stuff, right? Naira would have probably been somewhere about 1,000 or maybe 1,200.
Yeah, because we have so many projections.
Yeah, it would have been around
1,000, 1,000.
Yeah.
Well, we do hope the war ends as soon as possible. Thank you so much. Always great having this conversation with you. I'm Dr. Sonny Ayereze, Group CEO, DLM Capital Group. Thank you so much for spending the after Easter with us.
Absolutely.
Thank you, sir.
Thank you. God bless.
All right. We'll take a break now. When we come back, what's happened so far and what next? That's next. Do stay with us. We see Nigeria's banking sector has just gone through its most significant overhaul in nearly 2 decades, with 33 banks raising over 4.6 trillion naira in fresh capital to meet new regulatory thresholds set by the central bank. But beyond the headline numbers, a deeper conversation is emerging. This isn't just about how much, what that capital really means, how resilient is it under stress, and whether it can truly support the scale of economic growth Nigeria is targeting. Joining us now to make sense of it all is Dr. Olubukola Akinwumi. He's the Director of Banking Supervision at the Central Bank of Nigeria. Joining us from our Abuja studio. It's great to have you, sir. Good morning.
Good morning, Laddie. Thank you for having me.
Fantastic, and happy Easter and arrears at this point. So we see 33 banks met the recapitalization threshold, but how should we, interpret this outcome? Is this success in form or success in substance?
Thank you very much, Laddie. This is success in substance. I'll tell you right away, 4.65 trillion mustered by banks in terms of fresh capital, with almost 28% of that coming from the foreign investors tells you that there is confidence in the Nigerian banking industry and the Nigerian economy as a whole. We've had a few months back to exit forbearance, thereby ensuring that banks' balance sheets is transparent, and that confidence has been engendered within the investing community. What will this hold for the Nigerian economy? Of course, a more stable, strong, and operational banking system will muster the necessary deposits required to intermediate properly. I think it's very important to also note that the essence of this process is that value creation is now core in banking. What do I mean by that? We're not just going to see banks directing credit to specific sectors that they consider very profitable, though that may be challenged with a high level of NPLs. Now you'll see banks with a better capital structure directing credit to other sectors of the economy that is productive. In addition to that, we are going to be seeing a more competitive banking sector, more competitive in the sense that the headroom created by the recent recapitalization for many banks has positioned them to be more effective and be more involved in challenging the oligopolistic sector that you've had in the past. We should be seeing more competition, diversified loan portfolio, increased credits to the private sector, and of course, proactive capital planning to ensure that banks remain resilient into the future.
So I guess another nagging question at this point, what will happen to the banks that didn't make it?
When you talk of banks that did not make it, I wouldn't say there is one. You are aware that certain banks have been intervened and are going through judicial processes that will enable them go to the market and recapitalize in time. If not for the fact that there are existing legal issues that need to be vacated, they perhaps would have been able to also meet the recapitalization timeline. But we have to also give room for the dispensation of justice within the courts and allow the rule of law. Given that those banks have a different trajectory in terms of timelines for them to meet the recapitalization, the capital threshold stated in the.
So there's been a lot of commentary that capital is not cash. From a regulatory standpoint, what exactly counts as quality capital, and how confident are you that banks can deploy it when needed?
Thank you very much. You would agree with me that in defining the capital to be raised by banks, the Central Bank of Nigeria was very clear in 2024 that capital in this case will be the share capital and the premium, in which case we are expecting fresh capital harnessed by banks to be directed in strengthening the banking system. Having done this, it has positioned the Nigerian banking system to not only to mobilize savings internally, but also attract investments, whether in the form of equity investment or also in the form of borrowings from the international community to provide sufficient funding that can be directed to availing credit to the private sector. So there are a number of indicators of financial soundness, prudential indicators that are tied to the level of capital that you have as a bank before you can do more business. In that sense, those who are willing, and development finance institutions and other institutions like such that engage Nigerian banks in extending credit, lending to Nigerian banks are more comfortable and perhaps have more confidence now, given that the banks, Nigerian banks, are better capitalized and have enough headroom to attract more of such funding from foreign DFIs, and also extend such to an economy that is on the upswing.
So raising 4.6 trillion, naira, that's significant, but how much of this capital will, realistically translate into increased lending to the real sector? Because we've had a recapitalization before, and we still found ourselves in a place where, the private sector, the real sector was not really getting, the kind of lending that they would need. How do we make sure it doesn't happen this time?
Yeah, thank you, Ladi. The issue may not necessarily be that banks are not lending, but perhaps there's need to rejig the loan books of banks in a sense, where you have concentration in certain sectors. This narrative may be changing in the face of the need for banks to ensure that their credit exposure to certain segment of sectors is realigned towards preserving capital. In which sense, some other sectors which may that may have been denied or may not have had adequate credits directed to them may begin to gain from this process as banks ensure that they are very proactive in managing their loan books. In addition to that, like I said earlier, if you're able to mobilize more savings, it means there's more fund for you to intermediate. Aside that, engagement with foreign lenders who are readily engaging with our banks, especially in the MSME sectors, are happier to even lend more into the Nigerian banking sector. Just before getting on this program, we were engaging with some stakeholders, especially banks, in how to deepen MSME financing. And ideas and strategies that need to be deployed to de-risk that segment are things that we're talking about. And this will translate definitely into improved credit, access to credit by MSMEs and other sectors of the economy.
So we see the CBN is now emphasizing, stress testing and risk-based capital frameworks. Does this mark a shift from, meeting minimums to, proving resilience, under pressure?
Well, the new mantra is proactivity. Banks need to be proactive in managing capital. They have to be conscious of the risk they are taking. Enhanced credit risk management is required of banks. And when you talk of the stress testing framework, it is to ensure that banks are always looking at how to appropriately balance their loan book in such a manner that preserves capital. And where there is shortfall that they see, they are being proactive, or they are being required to be proactive in quickly remedying such shortfall. And the regulator is keen on, seeing through this process by ensuring consistent implementation of the risk-based capital requirement that is founded on the stress testing framework. We are continuing to engage with the banks to ensure that there is consistency in maintaining the resilience that the Nigerian banking system has gained as a result of the recapitalization exercise.
Right, and I'm sure, some bank customers are watching now and saying, what next for us? What does this mean, this recapitalization, cycle? What does it mean for us? Do we get better service? What do you have to tell them?
Great. Now, the first thing is, when banks are adequately capitalized, banks can improve their infrastructure for access. Channels will be opened up. There'll be more robustness in terms of the infrastructure and able to, support transactions and make transactions even more seamless for customers. again, like we have said earlier, there is more room for banks to engage in intermediation, and customers who have the bankable projects, who have projects with required cash flows, and who have done their own feasibility in ensuring that they can expand or open new businesses, have partners in the Nigerian banks. Now, aside that, businesses that are expanding as a result of credits from Nigerian banks will be able to employ more hands, leading to employment, and of course, as these employees are empowered and enabled due to employment that they have gained, they can access consumer credits. Businesses who will also, benefit from the fact that the purchasing, the customers or Nigerians, consumers are able to spend more as a result of being able to access credits, will have improved sales, which will again see mark a further expansion of their business. So it's going to be a more productive economy financed by credit, will in turn make the growth in the Nigerian economy more inclusive.
Right. I guess it's not just the real sector looking out for expectations. I guess the bank customers too have a lot to look out for. Thank you so much, Dr. Olubukola Akiwumi is the Director of Banking Supervision at the Central Bank of Nigeria. Thank you for coming on the show, sir.
Thank you very much, Ladi.
All right, let's pivot to the commodities market now. Definitely, we had Easter celebrations. Let's gauge consumer sentiments for these holidays and what's happening in the oil market. Joining me now, we have Assistant Vice President and Head of Economic Research at Financial Derivatives Company, Dr. Ifeoma Nwokolo. Great to have you on the show, man. Good morning.
Good morning, Larry. Thank you for having me.
Fantastic. So yes, we've had another holiday at this point, and I'm sure you've been able to gauge how the average consumer, fared this time. What was it like? The prices go up.
Well, Ladi, I would say that Easter period this time was not the way it used to be. There was little or no sign of festive excitement. Typically, during festive periods, we see a lot of increased consumption, we see social gathering and the likes. But this time around, Easter celebration is being shaped by what I call economic caution and living standard costs. Like the survey we did yesterday, we spoke with few traders, and the report we got is that people did not turn up as usual during Easter period. And if you look at prices, aside the spike that we had, all the gains we had in January was eroded because of the US-Iran conflict. And then by February, March, we saw a spike. But between Easter period, we were expecting to see a surge as usual. But I think there was no price gouging this time. Prices remained stable. But the only difference we saw was prices of chicken and turkey. Turkey went as high as 11,000 naira per kilo from 8,500, and chicken went from 5,500 to 6,500. But every other prices that we tracked that was during the Easter period remained flat. So I think people are becoming conscious in their spending, because even though prices have increased, income have remained muted, and people are spending wisely this time. So there's no discretionary consumption, or people are conscious of how they spend, and purchasing power has declined. This weakened consumption weakened spending across Nigeria. It's not particular to Lagos alone. So if you look at other markets, that prices remained stable. There was no sign that there was festivity season, honestly.
Right. I guess, when you have, fuel attacking your disposable income the way it did, from March. I guess it's a no-brainer at this point. So let's get a check on the oil market now. WTI, more expensive than Brent. It's a rare occasion. It happens every now and then. But now we're seeing the Strait of Hormuz. It's going to remain shut despite President Trump's deadline. What are we seeing play out there this morning?
Well, there's a deadline, yes. But the question is Iran going to hack into this deadline? And the market has already factored what we call uncertainty premium, even though we had a conflict premium before now. So there's an uncertainty premium of not knowing what is going to happen after 8 p.m. today, the US time, and 1 a.m. tomorrow, Nigerian time, if the Strait of Hormuz is not open. Of course, Trump has strengthened that he's going to begin to attack infrastructures in Iran if the Strait of Hormuz is not opened before or by 8 p.m. today. So, and you know that Iran may not yield to this particular deadline. And if they don't yield, what will the outcome be? Of course, we know if this happens, if they refuse to open the Strait of Hormuz, I tell you that oil price may go as high as over $120 per barrel. Yes, we should expect that. Then for WTI, is quite strange. WTI is usually lower than Brent, but today we are seeing that WTI is quite higher than Brent. One, we should note that WTI has more access now because it doesn't go through the Strait of Hormuz, because it is produced in the US and they don't have to go through Strait of Hormuz to supply. So it goes through Texas. So that's why we are seeing, so it's more accessible. That is why the price is higher than the Brent price. And for Brent, you usually have like a premium, and that is why the prices are usually higher than, but for now, the Strait of Hormuz are closed, and that is why we are seeing what we are seeing. But in all of this, Nigeria is at advantage because we don't have to go through the Strait of Hormuz to do our supply. So that is the trade route advantage that we have. So we have no geopolitical risk premium on Nigerian shipping as it is today. But the question is, yes, we are making the revenue as Nigerians. So there is a need for policy response. Up until now, we've not seen any policy response like every other country. In fact, yesterday, some people were asking me, on Sunday in church, I met some few people that were asking, why has Nigeria not done anything? Other countries are giving like a succor to the citizens, but we are yet to do something. People are like doing like a petroleum price ceiling, we have taxes being removed, we have subsidy being given to refineries to bring up pump prices, but we have not seen that effect take place in Nigeria. I know maybe because of some mechanical hiccups that we have, but I must tell you that it is needed this time because people are going through a lot.
Okay.
The poor are really getting the pinch badly. So the government has to do something about it. I'm not talking about conditional transfer or unconditional transfer, because if you do that, people may not benefit. And to avoid leakages, I think the best bet is to either subsidy for the period of time that this crisis is ongoing, or the government should give like subsidy to refineries that will cause prices of PMS, pump prices to reduce so that everybody will benefit from it. I think.
Right. Well, we all need to benefit at this point.
Exactly.
We've all been through a lot in the longest first quarter ever. Thank you so much, Dr. Ifeoma Nwokolos is a VP Research Financial Derivatives Company. Thank you so much for coming on today. Assistant Vice
Thank you
President.
for having me, Ladi. Yeah, thank you.
All right, we'll go global now.
All right, so it's time for global news. And of course, we're looking at the ongoing war between the US, Israel, and Iran, which has been dominating the news so far for about 39 days and counting. And first, when we talk about that, we're looking at European stocks First, we're starting up because European stocks are the first to open while Asia has already closed for Tuesday, and they're resuming from the 4-day Easter break, which started from Friday last week into Monday. So European stocks, particularly the FTSE 100, the opening numbers that we last tracked was down by 0.3% in early morning trade, while Germany's DAX was also down by 0.02%. On the other hand, France's CAC was up by 0.3%, and investors are eyeing what the deadline would turn out, which is 8 p.m. Eastern time in the United States and 3 a.m. Nigerian time. So the markets are struggling to digest the U.S. administration's mixed message on potential resolution to the conflict. At some point, we heard that the Trump administration is saying that it's signaling that the Iranian leadership is negotiating in good faith. But on the other hand, Trump is reiterating that his demand for Iran to reopen the Strait of Hormuz, which would allow traffic to start flowing through the vital route for global energy supply. So he's warning that he would decimate every bridge and power plant within 4 hours of that if that deadline is not met. So all eyes on the market. Now, away from the Iran war to entertainment. Now, first we talked about Paramount, but this time Universal Music is set for a takeover by a billionaire activist, Bill Ackman's Pershing Square company, which says it is planning to make about a $64.4 billion takeover of the world's largest music company, Universal Music. So that company's stock has risen by more than 10% early today, and is reacting positively. So the company says that it will be listing on the New York Stock Exchange according to the terms of the transaction, which is expected to close by the end of the year. So that's it. And still with the entertainment industry, a couple of weeks ago we saw that Paramount had made that successful bid for Warner Brothers. So this time they've secured a $24 billion funding from three Gulf countries, which is Saudi Arabia and the Abu Dhabi, and as well as the Qatar Investment Authority. So they're plowing into Paramount's proposed, the bid, $110 billion bid for Warner Brothers. Now the investors see the entertainment sector as a growth engine. By supporting Paramount's Warner Brothers acquisition, they gain exposure to global media portfolio that includes film studios, streaming platforms, as well as valuable intellectual property. So from there, we move over to Somalia, which is set for a historic first offshore oil drilling. And according to the country's petroleum minister, he described the move that is going to be a historic milestone, which would unlock offshore oil reserves and support the country's economic recovery as a regional energy player if the drilling were to be successful. He adds that the country would ensure that the benefits of the oil drilling would lead to national prosperity as well as improve the well-being of the people in the country. So we'll keep eyes on that eastern country, which is one of the most impoverished countries on the African continent. And from Somalia, we move over to India, where we see that the country has resumed its heavy importing of Venezuelan crude oil following the easing of U.S. sanctions. So they're purchasing heavy volumes of crude oil from one of the country that has the world's largest proven oil reserves. And according to data tracking, Venezuela's oil export to India has risen to some 342,000 barrels per day in March, up from 35,000 barrels in February. So that's it for India. And then from India, we move over to the UK, which is currently, we were talking about the financial services sector. So the UK's financial services sector, as the firms there are reporting the fastest turnaround since 1996. So that's about some 30 years ago. So now the strong profits from the banks have pushed the shares of these banks to their highest, which is the highest since before the global financial crisis in the early months of this year, and that's partly thanks to high interest rates, despite the $11 billion financial redress scheme for car loans and customers. Now, a stronger performance from the UK's financial sector will be a welcome development by the UK Chancellor of the Exchequer, Rachel Reeves, who has put the industry at the heart of efforts to increase the country's GDP growth, calling it the crown jewel of the economy. And so that's it for Global News for Tuesday.
All right, thank you so much, Anita. And definitely, markets are buzzing globally right now. We're seeing a lot of volatility, especially in the oil market. We're seeing Brent $108 per barrel. Oil, that's WTI, that's 112. Losing that 114 level at this point. So much volatility. Crypto, Bitcoin, that's trading at $69,000. Asia mix, Europe mix. So definitely the markets are moving. We'll bring you updates at 1:30 on Business Incorporated. And John McCall will be there at that time. I'm Ladi Williams. Thank you for watching. Bye for now.